Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, we're going to look at what is happening around the world when we start talking about flows. For those that have been watching us, you know that we've been talking about diesel being broadly short around the world, is on that distillate side. But gasoline is getting a little bit longer, especially when you start looking at some of the other areas. We're going to talk more about that in segment 3. And then we want to look at Russia. Russia is now selling Urals at a record discount of over $31 against dated Brent. And we're seeing some of these shifts that we really want to go through in more detail, because as it goes down, you will start to see some people coming through and actually purchasing. But the bigger thing is always going to be the favorite word and the favorite term that people like to throw around is demand destruction. And for those that watched last week, we talked about how in the U.S. demand destruction is not, well, I should say in the U.S. demand destruction isn't something where all of a sudden you just stop doing what you're doing. It's more along the lines you just do less going forward, especially when we look at the seasonal bumps. But we are seeing demand destruction in Europe as well as in emerging markets, and we want to go through those specifics. But then when we also want to look at the U.S. Gasoline demand as we go through the last few years, and especially some of those key years where we had recessions, to see, okay, well, where did demand go? And you'll see that it just went flat. It didn't go up, it didn't go down, it just went sideways, and that's something that we're seeing play out a bit at this point. And then we also want to look at what is happening between the offshore crude and onshore crude, because some of those divides continue to grow, just given the issues, especially in China, that we're seeing at the port side. So when we look at total, just doing the summary first here, you can see the total oil products. We're just outside of that 3-year average. The deficit narrowed from 120.5 to 119.4. So again, not too much to say when you look at oil and products, because oil had a bit of a build and products had that shortfall. So those are going to be some of the different pivots that we want to talk about when we're looking at, well, what products caused it and where is crude seeing builds versus draws. So when you look at total crude stocks, land and floating, the deficit narrowed from 51.7 to 47. That's something that, we don't see that going up or down. It's really just sideways, holding in at the lower end of that cloud. But then on the total product side, the deficit widened from 68.8 to 72.3. Some of that has closed, but it's when you look at globally speaking, we're still in a tight spot, and all of that is really actually driven by diesel. I mean, when you look at distillate, because gasoline, fairly normal in the U.S. Gasoline skyrocketed in terms of storage in Europe. We're going to see something similar play out in other parts of the world. So again, we just want to look at what is causing that, because it's not universal. And that's also going to shift what kind of crudes are purchased. And we talked about it in the Frac Spread show last week, where we looked at, well, what type of crude is there? Why is the U.S. not going to be this? Why shouldn't we have an export ban? Because some of those are the things that keep popping up on a political side. So now when we look at land storage, here you can see that the deficit narrowed from 84.6 to 83.1. Again, fairly flat. We had a little bit of a build in the U.S. We had a bigger build in Europe. And then when you look at west of Suez, the deficit narrowed from 74.2 to 69.3. A lot of that was driven by the U.S. when this was struck, which was last week. And this week, the U.S. had a draw of 2.51 million barrels, but Europe had a build of about that. So again, just kind of going sideways. And east of Suez, the deficit widened from 22.9 to 23.4. But you can see how the trend is going up. And what we're seeing right now is that the trend is going to kind of continue that move, very stagnant, not a huge shift. But China is really the one that is seeing the bigger increase. And you can see here that this is only looking at Japan. So again, that's when you start factoring in other parts of the east of Suez where we're starting to see those builds. So now when you look at floating storage, we still remain elevated. The surplus widened from 30.1 to 35.5. And remember, that's the shift between what is in transit to what is in floating storage. And we were saying that last week when we had that little bit of a dip, it was really that timing delay, because we saw the boats. It's just, when are they going to be classified as one or the other? And you can see here that they've officially been classified as floating storage. West of Suez, here you had the deficit narrowed from 4.5 to 2.8. A lot of that was really driven by West Africa, as the US and Europe still remain very low in terms of floating storage. And that's just because you have essentially everything getting waved in, especially in Europe, with the US staying at a very low clip versus historics, which will remain the case. But West Africa is the one where we continue to see those bills. And then when you look at east of Suez, the surplus narrowed from 38.7 to 36.9. And a lot of that is that timing delay, which they're starting to show up. So we should see east of Suez actually go back above that high, which was created in 2021. So when we start looking at gasoline implied demand, and this is just looking at the US. So here you can see that we had a big dip. The dip was a drop of 307,000 barrels a day, going to 8.6 million. That's below the 5-year average by 577. But there's a lot of noise in that, and that's what we've been talking about. Is this is just a snapshot in time, and we do expect to see a big makeup number this week because we had depending on where you live, either winter break, spring break. I know at least for us, it's for Easter. That's when we have our spring break. So we should see an increase, and you're going to see that makeup number, and it's all a matter of when does that happen? When do you see that snapback? So, here, when you look at the other months, 2019, 2020, it was a week earlier where we had that snap. So we should have seen it this week. Instead, we're going to see it next week. And again, it's just more normal. The question is going to be, what is normal? And that's when you start looking at 2009. So here we have 2007, 2008, 2009. But 2009 was really when you had that bite in terms of, the recession, people, things happened in 2008. Where did things settle out? And here's where when you go through that time period, you can just see that things just kind of went sideways. You had your bump that you normally have when it comes to when it comes to Memorial Day in May. But for the most part, you just kind of went sideways. There wasn't much to do when you look at these shifts up. And especially when you look at 2009 versus 2019, you get an idea of where things should be in a normal year, if you will. And instead we were below that. Again, 2009, very different from 2019 in terms of miles driven, cars on the road. But you just get an idea. I'm not looking at it to show where the number is going to end up, but just what happens when you have quote unquote demand destruction. It's in the US, you just don't have seasonal bumps. You just kind of go sideways because for those that can do more, will, and then those that are on the lower end just won't do as much. And that's where our demand destruction is going to come. Given if crude keeps rallying, gasoline prices keep going higher, we will start to see a more aggressive drop. But again, right now at this number, even though, yes, it's high, we'll talk more about this in segment 2, you're not going to get this huge shift down. So we will get a makeup number. It will go back above where we were in about 2008. But I just wanted to look at kind of what normally happens because I know that there's a lot of this back and forth. Now, European gasoline arrivals in the U.S. Climbed 277,000 barrels a day, highest since late April, since late January. Those are going to continue to come up just because PADDIII still has room. And we are seeing demand destruction in Europe, and we'll talk about where when you look at the big increase in storage. But this is just kind of that quick look at what has happened in the U.S. so far. So now when you look at crude stocks, we had a drop of 2.51 million. When you factor in the SPR, it was a drop of 6.7. The shift here is between PADDIII and PADDIII. So if you remember, PADDIII was the one that has continuously seen a drop, or the Midwest. But here you had PADDIII with a build of 2 million. Cushing had a build of 1.24. Again, the Midwest PADDIII still 30.1 million below the 5-year. Cushing still 20.8. It's just Cushing is where you're going to continue to see some of those builds. It's not going to be this huge move, but again, 1.24 is meaningful. You'll continue to see that go up. Now, PADDIII had a big drop of 6.56 million. And then, pad 4 and 5, small builds, nothing too crazy. But I want to focus on pad 3 for a moment, where you had that drop. So we did have a big increase in refinery run rates in pad 3 of 259,000 barrels a day. So you got some of these refiners coming back online. And if you remember, we said that pad 3 was going to start coming back on, the end of March, really start to pick back up in April. But sometimes there's a delay on when do the imports come in and as refiners ramping back up. And sometimes they can miss by a week or two. And I think that's something that happened here, where imports were still down. They're still, in pad 3, they fell 27,000 barrels a day. But it's 834,000 barrels below the 5-year average. So you're getting an idea that you had the run rates go up, imports really not meeting it as exports remained elevated. So here's where you got that big snapback. Now, as we said before, exports are going to remain elevated. They came in at 3.844 million barrels a day of exports. Excuse me, we think that it's going to average about 3 million, just above 3 million, and that's going to be where some of those shifts are in the crude flows. So we will see those remain elevated. Again, it's going to come down off that 3.8. So you'll get a little bit of that makeup number into pad 3 as crude oil production kind of remains flat. We have it at about 11.8 million barrels a day. And again, there's all of those issues in terms of not only just seasonality, frac spreads typically come down in March, and then they start to build back up as we go through into April and May. Here's what we were talking about with runs. Runs had an increase of 276,000 barrels a day. Pad 3 had an increase of 259,000 barrels a day, which is really kind of part of that increase. Pad 5, 109. So I'm not going to talk about the pad 3 increase against the 5-year, because remember, this was where URI comes in. So you're not getting a clean number on that. It's better to just look at what happened week over week. So here you had that increase. You had several facilities that were down. Pad 2 is the one that still remains elevated. We do think pad 2 comes down a bit, especially when you start looking at where some of the builds have been on the product side and where we'll see some of these underlying shifts. So just looking at this, just you can see that URI dip, which is that big, where we went below 60% utilization rate. So that's where things normally start to increase as we get into the end of March, beginning of April. Here you can see that we're running well ahead but when you start looking at it against the 5-year average, we're fairly in line with where we are. Normally it's a little bit high. I'd say it's higher by about 1 to 1.5%. But at the same time, we have a diesel shortage and you have a disti shortage. So might as well try to take advantage of that. But that's also where you're going to have to see an increase in those imports in order to get that higher disti cut that is going to make you the money that I think most people are hoping for. Now, when you look at imports, this is what we were talking about. Imports only increased by 92,000 barrels a day. Pad 2 was that small increase of 159,000. As we were saying last week, you'd get that bounce off the 5-year average, which we did. Pad 3 fairly flat at just down 27,000. We expect that to incrementally go higher and then stay elevated, just given where we'll see some of those additional barrels coming from. And then on the pad 5, continues to be lumpy. We were saying we would see a dip. We saw the decline of 240,000 barrels a day, which is but it's still 146,000 a day above the 5-year average. And we're going to just continue to kind of see that grind up, where most of the other places will remain a bit fixed. We expect pad 2 to remain elevated, but again, pad 3 is the one where we're going to see the biggest increase in those imports. Now, this is why you're bumping along the very bottom, and as we start to see more activity in the U.S., you'll start to see this trend higher. Again, I'm not saying we're getting back to the 5-year, because we won't, but we'll just get back to the highs of 2022 and really hold at those levels. Pad 2, here's that bump off the bounce off the 5-year. We're just going to stay elevated again, staying above the 5-year. We don't really see a big increase past, we could make a seasonally adjusted high, but we don't think that we're going to get back to those 2022 highs right now. That we will get there as we get towards the April, but right now it's just kind of managing what the flows are. there is room in storage, and if the spread makes sense, we could see an increase. But right now we're assuming something to be essentially from the 5-year to the peak of 2022. Then when you look at implied demand, gasoline had a drop of 307,000 barrels a day. We do expect that to reverse back up, and because we had kind of a seasonally mismatched draw. And one of the things that's the beautiful thing about gasoline and U.S. consumers, we hoard first. So if you're looking at Russia, Ukraine, you're looking at what people are hearing, feeling, there's some of that concern. That's going to, again, create some of this backdraft where people go run and hoard and fill up as quickly as possible, especially when you think prices are going to go up. And you had some of that pull through, and then you had spring break. So we do expect to see this number come above 9 million as we get into next week. But again, one of the things that we continue to talk about is just a little bit less activity than normal. Distillate, we were saying last week, was we were going to get a bounce. We had a bounce of 812,000 barrels a day, which is high. We do expect that to come down. As we were saying before, we expected to be between that, around 4.2, 4.3 million barrels. So we do expect a decline of about 300, if you will, and essentially coming right above the 5-year average. But again, just elevated. Jet had that big bump. We do expect that to come down and stay within that 1.4, 1.5 average when you start looking at the 4-year. Propane dropped a bit by 192,000 barrels a day. Still very strong, staying strong. We don't see that adjusting at this point. Now, when you look at gasoline implied demand, this is now just looking at the last 5 years, taking out what we were talking about with 2007 to 2009. You can see that we normally get this. We've seen this dip here before. It happened in 2020, 2021. We do expect to see that snap back and get much closer to where we were at about that 9.1 level. Again, still below where we normally are, but it's just good to kind of look at where things are and where they sit right now. Crude oil inventories, excluding the SPR, again, just kind of going sideways. You're going to see that managed as exports remain elevated. You're going to see that managed with more imports into PADDIII and PADDII. But again, we just see that holding firm at this point. Days of supply, again, also flat. This should dip a little bit just because we did have a big increase in refinery run rates, and we did have a little bit of a draw on crude. So we will see some of that come down a bit, but you can see here it's still in a fairly comfortable position. Now, when you look at total oil, crude, and products, we had a nice drop again, and a lot of that, we had a drop in gasoline. Gasoline dropped 2.95 million. Then we had disti drop 2 million, but the disti drop is the one that we're talking about the most because gasoline is still very in line with the 5-year. It's just the disti is the one where we've seen the biggest shift. And even with that drop, we did have a fairly sizable export into the European market, and that's something that's it's gonna kind of be that battle back and forth, where we've had the opposite, where we've seen Europe sending diesel into PADDII. Now we're coming back into a bit more of the normal, if you will, where the U.S. From PADDIII sends diesel into Europe, and as Europe struggles to replace Russian diesel and other products, it's going to pull a bit more from the U.S. Gasoline storage, you can see that we're right at that kind of tip. Do we normally get this dip here? So even though it was a drop, you can see that we're still pretty close to where we should be for the storage period. That's something that we think is going to see one more drop, just because you'll get a bit of that pivot into, and we'll talk about Gas Buddy, because Gas Buddy had a fairly sizable increase in demand, and that's looking at the pump level, so at the consumer level, where implied demand is looking at what is left the racks, and then this is looking at what's in storage. So again, you're going to see some of that catch up overall as we see some of these different flows. Distillate still moving down. Rate of change versus the average is stable. But again, even though it's stable in terms of the declines, it's still a decline. We're still very low versus historics, and there is that global shortfall. Jet had that drop. Again, we had that increase in implied demand, which is that movement from the racks to the end user, which again is that flow through from storage. This can also be left in the disty pool, so you're going to have jet that's going to be a bit volatile, but it's nothing to be too concerned about. Now, when you look at WTI, I shouldn't say too concerned in terms of availability, but you should be concerned based on jet fuel prices, because that's something that that has happened. Some of those prices have come down a bit for those that have been tracking airline costs. But again, that's something that's still going to remain high. Here, when you look at the fair value, you can see that the curve has shifted back up. We're now back above 110. We're crude WTI is at 114 and change. Yeah, we're above 100 through essentially till the end of this year. We're above 90 for the next 12 months. And then you can see that against that 70, even though things have continued to shift, but you can see that even the belly of the curve has moved up and out as we have some of those issues in terms of supply. Because as we've talked about in our insights, the longer Russia faces these sanctions, the harder it's going to be for them to maintain their production. It's not a straight drop, but it's something that will eat into their production capacity going forward, which again is creating some of those longer term shortfalls, which is pulling that belly of the curve higher. COVID remains elevated worldwide. Again, Europe has seen a bit of a curve up, and that's just with, I think it's Omicron 2 or whatever they're calling it nowadays. And it's just, you're seeing it stay a bit elevated in the UK. Europe is a bit flat. Asia Pacific remaining elevated as well. Thailand, South Korea, Vietnam, India is still fairly flat. And then you're seeing those remaining increases that remain in China, resulting in some additional shutdowns, which we'll talk about in a minute. Crude oil and PADDIII, this is what we've been saying, just kind of, we also normally see a bit of a decline at this point in time when you look at 2020, when you look at 2018. And again, it's just that timing delay of when do the refiners come back from maintenance? When do they start seeing those imports? And sometimes you can get a bit of that time lag. You can see in 2019, that pink line, we had that pretty steep dip. It's just going to be a matter of, where do we see some of these builds and increases. Now, when we start looking at crude oil and floating at Cushing, here you can see that we've had a bounce off the lows. We expect that to see a fairly steady increase, but not something of a continuous 2 million or so, but anywhere between that 500,000 and 1 million barrels increase in Cushing. And then when we look at floating storage, still seasonally adjusted all-time lows, and that's just because there's a lot of that pull coming straight through. So we do expect this to remain on the low, seasonally adjusted all-time lows, slightly above the low that we had this week, just in terms of those timing delays. But again, we're still going to see a lot of those pulls into the market in general. So that's what we have for you here. In the next segment, we're going to go much deeper into what are consumers thinking, how are they shifting, how are they viewing some of these additional adjustments, because I think that's a very important conversation to have as we start talking about demand in general.